Consolidation on full-owned company 100%. Introduction. In business practice, a parent company can own all shares of other companies, which are referred to as subsidiaries. If the ownership reaches 100%, then the parent company fully controls the subsidiary entity, both in operational and financial terms. The process of consolidating a fully owned company is relatively simple, as no non-controlling interest KNP needs to be recognized. However, it is still necessary to eliminate accounts and transactions between companies so that the consolidated financial statements reflect a single economic entity. B. Features of full consolidation. The parent company is considered to have full control if owning 100% common stock of subsidiary companies, fully entitled to all profits/losses of subsidiaries. No outside party has an interest in the subsidiary. In other words, all assets, liabilities, revenues, and expenses of the subsidiary are fully considered part of the business group. C. Full consolidation objectives. 1. Present combined financial statements that reflect a single economic entity. 2. Eliminate the effects of internal transactions to avoid duplication of assets, income, or debt. 3. Provide a complete picture for investors, creditors, and regulators. D. Consolidated steps for a fully owned company. 1. Delete investment account. The parent company usually records investments in subsidiaries as assets, for example, investments in PTXYZ. In consolidation, these accounts must be eliminated and replaced with assets and liabilities of subsidiaries. 2. Combining financial statements. All subsidiary accounts' assets, liabilities, revenues, and expenses are fully incorporated into the consolidated statement. 3. Eliminate transactions between entities. Some internal transactions that must be eliminated include accounts receivable and debt between companies, intercompany sales and purchasing, dividends paid by the child to the parent, unrealized profit from the sale of assets between companies. 4. No need to record non-controlling interests. Because the child is owned by 100%, the entire profit/loss of the child is recognized by the parent, and no part of the profit is allocated to outside parties. E. Simple examples. For example, PT parent bought all shares of PT Anok for Rp1, 0. Net asset value assets, debts of PT Anok is Rp1, 0. In the consolidation process, account investment in PT children in PT parent worth Rp1 million deleted. All assets and liabilities of PT Anok are incorporated into PT parent S report. No recognition of KNP because all rights owned by the parent. If there is a transaction between the company and the company, for example, sale of goods, then the value of the sale and the related profit is removed. F. Benefits of full consolidation. Transparency. Displays an accurate overview. Reporting efficiency. No need for KNP calculation.